50 years ago, it was pensions and Social Security that were going to float me and you through life.
Yeah.
Right. Well,
For sure.
what they said is like, hey, we're undoing this pension system. Social Security is now less representative of like, I mean, back in the day, a person could live in retirement off of Social Security, like 100%.
Yeah.
That's not like, now it's like maybe 20 or 30% of what most people spend is what you're going to get.
Yeah.
So if that's the case, we have to find a way to encourage you saving for your future. Welcome to Money Therapy, where every dollar tells a story. And most importantly, so do you. I've explored thousands of podcasts discussing tools, tricks, and hacks to grow wealth. But when they failed me, I started asking why. The answer was clear. For a different output, I needed different inputs. So I shifted my focus from mere tools to more deeper sense of self. I started focusing on my identity, beliefs, values, goals, and vision. Once these were aligned, the same tools that were failing me before started to work. Join us at the intersection of life and money, where you are the ultimate asset in generating wealth for your life. Let's master our money, not be mastered by it. Don't forget to like, subscribe, follow, and share for your weekly dose of money therapy, helping you turn wealth into a seamless part of your life's journey. Together, we're going to eliminate financial anxiety and hopelessness and gain confidence and clarity. Now, let's dive into today's episode of Money Therapy. You're up.
All right. Welcome back, everybody. Another episode of Money Therapy. I'm Bill McGill alongside Brandon Chastain, and we are going to talk about 401ks today. Brandon, did you know that 401ks are a complete scam?
I've heard that before.
Have you?
I have a couple opinions about them.
All right. Well, yeah. I heard this from my physical therapist a couple of weeks ago, and this is why I wanted to talk about it, because I've heard it before online from, like, I think Grant Cardone came out very famously and was yelling about 401ks being a scam. And this guy made a pretty interesting point that I wanted to talk about. He basically said, to sum it up, he likes to invest in real estate a lot more than the stock market because he believes that 401ks in the stock market are somewhat of a scam. And basically the main point that he made was the fact that the government incentivizes everybody to make contributions to their 401ks and everything. The stock market is going up kind of artificially because we're all putting into the stock market, and the government ensures that to happen. And I had some points that I made back to him, things to think about as he was like stretching out my back and my hamstrings and stuff. Not the best place to have a financial conversation. But I think it's an interesting conversation because I actually ended up agreeing with some of the things that he said. Overall concept, I didn't really, but I wanted to just throw this ball into your court. So you have heard of this. Did you hear, Grant Cardone? Where did you hear this from? Where do you think it came from?
Probably my side of Twitter.
The dark web.
Just all of us tinfoil hat wearing guys I don't know. I mean, I've heard conversations just about there's always incentives to participate from our government, and the question is like, why are we being encouraged to participate a certain way? Is it because something's broken on the side of the government and they need our help, or is it because they want to kind of manipulate and control us and keep their thumbs on us as people? Maybe it's a little bit of both. So
could be the Russians. You never know.
Could be. They're in like the Florida Gulf right now, right?
Yeah. There they go. So I wanted to kind of dig into this overall concept, because in his head, and I've heard this before again from the 401k, is that, and I think the first part that, because we're definitely biased, Brandon. We deal in the stock market pretty much exclusively with our clients, right? We do give advice about when to buy a house and when to sell homes and things like that based on their entire financial situation. But
I think that's an opinion.
Okay.
Right. And that's, one of the reasons why I do I encourage my clients to do like a flat fee financial plan is because there is like I'm not incentivized at that point to put money in your market. A lot of financial planners are, right. They you put money in the market, they manage it, and they charge you a percentage of what they manage. So there is bias there of incentive.
Oh, for sure.
But once you get into like the financial fee or financial planning for a fee space, you're just picking my brain and we're solving problems, and it doesn't matter how or where. So
yeah, that's a great point.
Yeah, I just want to clarify, because a lot of people do think that. They're like, oh, well, of course he's going to say this or that because of, and we have done a good job at our firm, and in the industry as a whole is making this more available to people to say, hey, if you don't want biased advice, just write a check to sit with me and consult with me for time on your financial plan.
Yeah, which is not a bad way to do it. Right. I guess, another thing that I just meant is like we deal heavily in the stock market, right? So we are inherently biased. But so I wanted to challenge this notion, and part of this conversation was, in the first comment that I made to him, is that I believe, and I want to hear your thoughts on this, that the real estate market and the stock market are very dependent on each other and very influential on each other. What are your thoughts on that? Do you see that, because I hear a lot of times in the news that, people look at the stock market and then they speculate on what they think the real estate market will do, or they hear what the Fed interest rates are going to be, or what we think, if there's going to be cuts, raises. And then they usually go, what's going to happen in the real estate market because of that? And then what's going to happen in the stock market? So what is your opinion on those things being intertwined? I see those as very intertwined and very, like I said, dependent on each other. What are your thoughts on that?
Yeah, I mean, I think at the end of the day, they're both, assets. Like whether you buy a stock, a bond, or a painting, or a house, or a piece of jewelry, like it really doesn't matter. When you buy a fixed asset, when you buy a hard asset, you buy assets in general, the value of those assets are going to be, they're going to be affected or impacted by how our economy is going, and our economy is limited. It's reined in. It's put inside of a kind of performance box based on monetary policy and fiscal policy, and then all the laws and things that get passed. So I think at the end of the day, they're both synonymously kind of manipulated a lot intentionally. I think some of it is meant to, like, when you focus too much, like for example, when you focus too much on putting a ton of money into the economy, you get runaway inflation. So like part of it is probably to try to put limits on things like runaway inflation, corporate greed, and all that stuff. But then at the same time, like those policies can be adjusted for, economic or business cycles when money would otherwise dry up and run out and be really kind of depressed for a season of time. That fiscal policy could put like a little boost of energy into our economy and get us through something quicker. So, but yeah, I mean, at the end of the day, it doesn't matter what you're buying into. Both are kind of manipulated and controlled by our government.
Yeah. And I guess I'm pointing that out because in the context of this conversation that I was having, it was almost as if, he basically labeled, okay, 401k is the stock market is a scam. And so that's why I do real estate. Right. Almost in an effort to convey that he's insulating himself from one thing or the other. And so I think it's important to like distinguish how much they're intertwined, how much they are, because he was, again, manipulation of the stock market by the government. But then, in my opinion, to pretend like the real estate market's not manipulated by the government, I think is kind of ridiculous.
I think we call that
point that he overlooks. Yeah,
I think we call that anchoring, right? It's like I'm going to look for all the things and all the realities, all the facts that I can find to support my belief. Because one, he needs to believe what he's believing, but two, he's going to try to have the evidence to convince you that he's right. And like when we're doing that, we tend to look past all the other facts that don't support our thesis or our beliefs. And so in this case, he's like, oh yeah, well, I'm totally focused on the idea of like Department of Labor and FINRA and the SEC and ERISA
Right.
and like all these other things that are contributing to the manipulation of the stock market. But like, what about the Federal Reserve? Those guys exist too. And that actually is going to impact the price of houses.
Yeah, absolutely. And I want to give this guy credit. He was bringing this up in a way that he was really interested in having a good conversation. Like, was definitely challenging his opinion at the same time. He was like, "Hey, this is what I think and why, but what do you think? Because you're on the other side of the coin here, or at least how he viewed it." And so it was an interesting conversation. I want to point out something that I agree with him on, and why. First of all, like the definition of a scam, I think, I think he's using that a little bit incorrectly, right? A scam is complete fraud, misperception, tricking people, usually in a monetary way, right?
Sure.
And that's not exactly what we're talking about here. I think he really means that manipulation of the market, or in his sense, the fact that the market was fixed. And so I want to talk about a little bit of what I agree with him on, and that is, one of his key point was, well, you have all these employees all over the country and employers contributing to the stock market every single month. And so that is effectively kind of rigging the market to go up, right? And I kind of agree with that, because it's like, yes, if all of American businesses don't go out of business at exactly the same time, and there's at least one of us contributing every single month to the stock market, there's inherently a floor to how low the market can go.
Sure.
Right. We should coin that term. How low can the market go? But so if Americans, as we get educated, pump more and more and more into the stock market, there is inherently a floor somewhere of where the market could come down to. Again, assuming that all the businesses in America doesn't go kaput in a weekend. Right.
Yeah.
So that is part of, I do agree with that. But
wouldn't that create like a sense of safety for the person participating in the 401k? Knowing that I'm joining kind of an army of people that are doing similar things. So there is kind of a max potential downside here. I mean, and of course, all investments can always go to zero. Let's just be very clear about that.
Absolutely.
However, but in this kind of thinking, because it's not completely wrong,
right.
Is that a design that is supposed to manipulate me, or is that a design that's actually a protection for me?
Yeah. And I think that's one of the things I want you to talk more about that, because so that was the other point, is like, well, we all are kind of buying into this idea, and I think we both agree on this, but we're all kind of buying into the idea that the American economy will be worth more in 10 to 20 years. And that's what makes us investors, right? Otherwise, I wouldn't, not a whole lot of Americans are buying into Venezuelan currency today, right? Because they don't know what it's going to do in 10 to 20 years. So do you agree with that? Like, hey, I guess like that we're all kind of buying into this system of, we think America is going to be better in 10 to 20 years. Do you agree with that way of looking at it? Or do you think that he does have a point in terms of, well, it's kind of fixed because we're all forced to do this? Like, how do you see that, that side, those two sides of the coin, I guess?
That's a good, I mean, for such a wide, like open-ended question. So first and foremost, like most 401ks, you don't have to buy US companies inside of a 401k, right? So you can buy global, you can buy bonds, you can hold your money in cash inside of 401k or cash like, right? So nobody's forcing you to buy into a specific investment.
Sure. It's a good point.
So there's that. And I think, now, is it encouraged to invest your money inside a 401k? Probably. But again, it like, is it a chicken or the egg kind of thing? 401ks have not always existed, right?
Yeah, true.
So go back into like the 1930s, 1940s, 1950s, the stock market was still increasing over time.
Yeah.
Right. So yes, I do think if you're an investor, you have to think I'm pro future.
Yeah.
Right. Now you can actually be kind of like we hear it in the news all the time, like a bearish kind of investor where they're actually betting down the market.
Sure.
So you could actually be the antithesis. You could think the future is going to be way worse, and you could bet the market down.
Yeah.
But the point is like the market over a grand amount of time, 100 years,
Yeah.
has returned, like has net positive returns to people that have placed their money in investments inside of the U.S. market.
Yes.
And so, and that history started long before the history of the 401k, right? So we can't say like, oh, the 401k is like the only reason the market's performing well, like, because that's not true.
It's true.
Right.
Yeah.
Because it was,
I mean, it's a good point. Yeah.
Right. So if we kind of step back and put this stuff in order, right?
Yeah.
I think the reason 401ks became more popular is because companies needed more profitability. And in order to be more profitable, they couldn't keep dumping all the money into pensions. So, again, 50 years ago, it was pensions and Social Security that were going to float me and you through life.
Yeah.
Right. Well,
for sure.
What they said is like, hey, we're undoing this pension system. Social Security is now less representative of like, I mean, back in the day, a person could live in retirement off of Social Security, like 100%.
Yeah.
That's not like, now it's like maybe 20 or 30% of what most people spend is what you're going to get.
Yeah.
So if that's the case, we have to find a way to encourage you saving for your future. And I think, again, I do believe that there's some manipulation. I'll explain my beliefs as to why there's a little bit of conspiracy, or my conspiracy thoughts to 401ks in a second.
Yeah.
But I will say, like, just like we can't have a bunch of like parentless kids running around without any, so like we have, it's not great, right? But there are institutions, there are government and nonprofit organizations that are trying to take care of like parentless children in our country, right?
Okay.
Foster systems, there's subsidies, there's a lot of things, there's all these things available to people who will adopt children, right? So we're trying to encourage, if there is a child that doesn't have a parent, we're trying to encourage, adoption is the goal. But there's foster systems in between. Long story short, it would be a disaster if those things did not exist in America.
Yeah.
The same side, like for all those people that didn't save enough or to save it all coming through life, and they get to where they're 60, 70 years old, healthcare costs start spiking. Like, what if there was no subsidies for them?
Yeah.
You would see a bunch of old people like just dying on the street, poor, broke, and hungry. We can't have that either. Right.
Yeah.
So if the government's like, hey, we can't keep spending money on, like, we can't keep fully funding retirement through Social Security. If companies are like, hey, we can't be profitable and have people living longer and have all these things through pensions, then how do we get people to start saving for themselves?
Yeah.
And that's where you get the incentives.
Yeah. And I think also at the same time, like, I think there's a couple of factors that have set us up for today. So the overall story that I tell clients is exactly what you're saying. Like back in the 60s and 70s, or even even to the 80s and 90s, like your Social Security check was 90% of your income in retirement. Or call it pensions or Social Security. And then your 401ks or IRAs or other investments was about, 10 to 20%, we'll say. Today, that's completely, like, especially by the time you and I retire, is going to completely flip. We're going to be at, 80 to 90% of our income is going to come from our investments, things like real estate, things like our 401ks, IRAs, and then 10 to 20, the Social Security check will just be kind of fluff on top for most of us, especially, with all the news that we hear about Social Security. I think that happened, my analysis, and again, this is just totally my opinion, but, when the baby boomer generation came into effect is really when Social Security started ramping up for the most part. I know Social Security, I think, was established in like the 20s and 30s and things like that. But baby boomers came home, or, they came home from the war, the baby boomer generation, the, massive explosion in population in the United States for the next 30 years happened, right? But people weren't living necessarily longer because of medical advancements. They were getting better, but not to the extent that people are living today. The average, we've heard this many times. You would retire, live on Social Security for about 2 years, and then you would pass away, at 68, 70 years old. Well, now, as we know, it's, 82 is for women. I think 79 or 80 is for men. So you have this entire generation of people that are living longer, getting older, incurring more expenses. So therefore, Social Security can't keep up with all of that, in my opinion, as we see as a result today. So I think over time, I think to their credit, the government was paying attention to that. Birth rates in America going down, not as sustainable as, we didn't go to baby boomers and then keep going up. Our birth rates have come down over that period of time. So I think the government looked at that and went, hey, we need to incentivize businesses and our own citizens to be more self-reliant off of the Social Security system that we're focusing on today. And so they started giving incentives to employers and employees through IRAs, 401ks to start that transition of less reliance off the social systems of Social Security and more onto yourself. It's kind of a big history lesson there, and I could be wrong about some of it for sure, but that's kind of what I see going on with the market. And I think the underlying theme here, and I want to know what you think about this. I'll kick it over to you in a half a second, but back to the physical therapist, again, he kind of assumed that he was insulated from, maybe the 401k stock market because of his love for real estate and his thoughts on real estate. But the fact of the matter is, for the market in either case to go up, we all have to, back to what you were saying, we all have to buy into this system that we think America is going to be better off in 10 to 20 years, or at least the world is as well. Because as you pointed out, you can invest overseas or you can invest domestically. And so I kind of look at it as, hey, man, we're kind of all playing in the same sandbox. Like, the 401ks and the real estate are both tools to kind of insulate yourself from the government. And it seems like they are incentivizing us to do that. But at the end of the day, we are American citizens and we live under the umbrella of government. And so we are in the same sandbox, and there's rules to that sandbox, but there's a lot of different ways to get ahead and a lot of different ways to insulate yourself as much as you possibly can. What are your thoughts on that? Do you think that that's kind of a good metaphor for all that? What do you think?
I guess I really think that, like, most people that are listening to this podcast are not worried about the 401k being some sort of like government conspiracy. Yeah. Right. There's a few tinfoil hat wearing people out there. At the end of the day, at the end of the day, like, diversification is important, right? Don't show up, kind of what I said in pre-show is, like, I'm not going to show up to a work site with just a hammer. Yeah. Like, I'm going to bring my entire tool belt. Right. Yeah. Because different things can come about. Sure. My belief, we saw it in 2019, right? This to me is the detrimental manipulative part of participating in any kind of retirement plan. So whether it's 401ks, IRAs, it doesn't matter. When you start dealing with ERISA, Department of Labor, and what the government can do through legislation, you get something like the Secure Act. Now, most people have heard about the Secure Act 2.0. Yeah. If you haven't, you can Google it. But there's legislation passed in 2019 that effectively changed some of the dates inside of when we typically have certain things happen in those in like the 401k space. So yeah, in this particular legislation, they changed what they call RMDs, required minimum distributions, from the age of 70 and a half to the age of 72. Yeah. So that doesn't really change that much. That's really about when the government can start forcing you to take money out of your 401k. And so that way you have to pay taxes. Yeah. So it's important to them. But the other side of that coin is there is nothing stopping the government from passing a law this year that would say, hey, instead of having access to your 401k at 59 and a half, you now would have to pay penalty if you withdraw anytime before the age of 65. So effectively, if you're in your late 50s, and I have clients who have massive wealth because 401ks are good, and they have built a massive amount of wealth inside their 401k, right? But I have one client that turns 62 next month. Okay, he was just in for a meeting. 90% of, well, maybe like 75% of his wealth is in his 401k.
Yeah.
Okay. I told him at this last meeting, like, hey, dude, congrats, you're fine. You are officially work optional. You can tell your boss to shove it any day you want to. As of now, like he has you on borrowed time, right?
Yeah, I can't
It was a
wait for
real
the day I can tell my boss to show it, dude.
he
Can't
he's
wait.
a he's a really he's in a really good spot. He's 62, so fully able to retire anytime he wants now. Okay.
Yeah.
The problem is what happens, we're assuming that is only true because he has access to his 401k right now, right? If he retires.
Yeah. It's
But
true.
what if the government came back this year and said, "Hey, we're changing that to the age of 65." Now it's like, "Hey, dude, now you can't retire until at least 65 because all your wealth is in this one basket." Right?
Yeah.
Or at least most. So, bottom line, diversify, right? That's but let's set
Definitely a point
aside
to real estate.
let's set aside the tinfoil hat piece, because I think like when people are listening to this show, what they're really thinking and wondering when we talk about 401ks is like, should I use it? How do I use it? And is it going to help me?
Yeah.
Like, so we've had fun. We talked about the conspiracies in the government thumb, and we're all part of the system, and them and they, and the lurkers and the lizard people, and China spy balloons and all this stuff. So like, okay, let's take the tinfoil hat on
this.
Let's just say, okay, when we're talking about 401ks, so we can just broaden that. We can say like also like IRAs, SEP IRAs. We can talk about all this stuff. Anything that has tax incentive for you to save in it for retirement. That's what we're going to talk about. Okay. The people that need to listen to this are people that are working and earning money. Okay. Yeah. So if you're listening to this and you're like, yeah, I earn money right now. Cool. This is for you.
Yeah.
Now, the question that you might have is like, should I be using these retirement plans, or should I be buying real estate, or should I be buying gold, or should I be doing this? And it's confusing. It's a lot, right? Okay. So let's start talking about this. And ultimately, let's just say all these people that are listening that are earning money right now are thinking, hey, to your point, I want a better life in 10, 20, or 30 years. And I ultimately want to be work optional. I'm tired of being stressed about money. I'd like to have enough to not worry about it. And I definitely don't want to run out when I'm 90.
Yeah.
Okay. So now the question becomes, should I use a 401k? Bill, should I use my 401? Like, should I? I'm asking you.
Yeah, absolutely.
Okay. So if you have access to a 401k or retirement plan, the goal should be, let's leverage it. Why? Yeah. Because anytime I dump money in this stuff, I am reducing my tax burden one way or another. If it's a 401k, if it's a Roth IRA, traditional IRA, SEP IRA,
absolutely,
solo K, like 401k, like whatever it is. If it's an ERISA plan, there's going to be some sort of tax advantage.
Yeah.
Now, should I put all my eggs in one basket? Probably not. It's probably not.
There's a lot of tax advantages to real estate, right? Depreciation, appreciation, 1031 exchanges, like all that.
They're also not like super liquid, right? Kind of hard to just sell a house tomorrow unless I discount it by 1,000%.
Right. There are pros and cons to each, absolutely. But, for instance, if you're married, your primary residence can go up, appreciate by $500,000 from when you bought it, and you don't pay any taxes on that money. So there's pros and cons to both, which is why you should diversify. I mean, anything that saves you taxes over the long term. That's why we preach a lot about Roth IRAs too, because it's like, hey, instead of being that guy who's concerned about what the government will do in terms of moving up or moving back the dates of, controlling when that person can retire, if you got a Roth IRA, after 5 years, whatever you've put in and the growth on that, whatever you put in, is tax-free anyway. I mean, penalty, obviously 10% penalty before retirement. But again, we're talking about insulation, getting as free, as financially independent, I guess we could say, financially free as we can within the sandbox that we're all playing in. But the fact of the matter is, you can't jump out of the sandbox without going to a different country. And I'll go to
even then you're going to play by the same kind of rules.
Yeah, I mean the world is, then you get into globalization, the world is very connected, all those things. So I think it's okay, for people out there like, damn, I'm a part of the system anyway. I didn't want to be part of the system. It's okay to be a part of the system. There's a lot of good things happening in the marketplace. And that's a huge thing, being financial advisors. And that's what we coach people on, is how do we maximize all these things to get you to have as many options as possible at the end of the game, and that's a good place to be.
So I need to talk just a couple points because, like, again, answer the question, should I use a 401k? First off, a 401k for those that have employer matching, like as an option.
Yeah.
It's one of two things that exist where you can basically get an ROI at 100% or greater immediately. Right.
Yes.
The only other one really is like an insurance product, right? Like I can buy a term policy and make my first, $50 payment and immediately be worth $1 million.
Yeah.
Right. Now I have to die to get it, but
real quick, let me jump in on the 401k. So guys, if you don't know how a match works, let's say you make 100,000 a year, your company matches 3%. That means if you put in $3,000, the company is automatically going to match your 3,000. So 6,000 goes into your retirement pool.
Yep.
So that's
you contributed 3,000.
Yeah.
Now
you got 3,000 back immediately. That's 100% return. That's what Brandon's alluding to in that. So just wanted to say that real quick. Sorry to interrupt.
No, you're good. Yeah. So like if your employer does offer matches, then you're effectively leaving. And I tell clients this all the time. They're coming in and they're talking about, well, I wish I'd have a raise. Like I need to talk to my boss about like my next raise. And I'm like, are you contributing 401k? Like, no, not contributing to 401k. That's why I need a raise so I can contribute. I'm like, yeah, but if he's offering this 4% match, he's basically saying to you, if you decide to participate, instead of you making $100,000, I'll pay you $103,000. So a simple decision on your end, is giving you a 3% raise.
Yeah.
Right. So a lot of times I tell people, like, I personally, if I was a boss of employees like that, if you come and ask me for a raise, I'm like, cool, participate in your 401k. There's your raise.
Yeah.
Right. And then we can talk about other raises after you're taking advantage of all the things as an employer I'm offering you.
Yeah. And again, big picture, like nothing's ever guaranteed. And so we understand that real estate's not a guarantee, stock market's not a guarantee, but it gives you the best chance that you can possibly have in our world and in our country today of having that financial flexibility later on in life.
Yep. I had a client, and this is like I mathed it out. Like I looked at this because I didn't believe her when she told me. But because of the way our tax system is, and we have this kind of like tiered tax system that like the more money I make, there's thresholds, right? So at a certain number, 20% of my money starts getting taxed. And then at a certain number, it's 30. And then, it goes up to like whatever the top tax bracket is, but it happens in tiers, right? Yeah. One of my clients, we were talking about, getting started. So here's my advice. Like, this is what I want you to know about 401ks. If you're not participating, go turn on if you have access to it, turn on 1%. Just set it up, start contributing 1%. This is not going to be true for everyone listening to this, but for this one client, because of where she was in this income threshold, she actually started contributing 1%. Her employer was matching 1%. So she was actually getting 2% of her salary saved every year. But her net income on her paycheck actually increased. It went higher because that 1% contribution that she was making dropped her income just low enough to like get rid of that money above the tax line.
Yeah.
So she was actually paying less in taxes, and that 1%, the 1% she was giving versus this tax savings, she actually netted a positive amount. So by turning on 1% for her, she actually started bringing home more money we're talking dollars here. Like, it wasn't much.
Yeah,
but she thought I was going to like, if I turn on 1%, I'm going to have to learn to like, I'm going to have to, cut out, $50 a month in spending.
Yeah.
And she actually had like $55 more a month.
That's nuts.
So
that's a success story right there.
Yeah. So turn on the 1% and then make it a goal. Like if that's your only financial goal right now, if you're like struggling, and because groceries are expensive, everything's expensive, insurance is expensive. If you're in that place where like everything's expensive, just try it. Like turn on 1% and then make it a goal in like a year to be like to double it to 2.
Yeah.
Like so 401ks, like I think at the end of the day, what I want people to hear is it's a tool. If you have access to it, if you have access to IRAs, anytime that we can put money in a qualified account, we should definitely be exploring if it's a right fit for us. And very, very infrequently should a person not participate. And there are times, and again, I think how I can help, how we can help is if you're hearing this and you're like, hey, I need some sort of like retirement savings analysis to figure out the best ways for me to save for my future.
Yeah.
We can help you. Like we can look at your cash flow, look at your tax impact and say, hey, I think really allocating money here, here, and here, or based on your goals. Maybe you don't want to retire. Maybe the bigger goal is you want to buy a car soon. If you're in your 20s and you need a car to get to work, don't put money into your 401k that you're going to need before you're 59 and a half, right? Yeah. So allocation, diversification, these are the names of the game, right? I want to save tomorrow's money in something liquid. I want to save retirement money in a qualified account. I think those are the important things to know.
I think that's a good place to wrap up, man. I think to summarize, like 401ks, we don't think that they're a scam. We think you're safe. Now, if they are a scam and we're just have no idea what we're talking about, diversify, allocation, long-term, short-term time horizons. You know, what Brandon just said is, again, name of the game, give ourselves options, insulate us from the possible scams if they are. Again, we think 401ks is, and the data tells us it's a massive tool to wealth in America. And we should actually do a full episode on that, I think. But at the end of the day, I think we wrap it up. Brandon, you cool with that?
Yeah, sounds good.
All right. Well, guys, we appreciate y'all joining us. You can find us on pretty much everywhere you find your podcast. Please listen, like, subscribe. We are also on YouTube, so leave a comment, like, subscribe there, share with your friends. And if you need to reach out to Brandon or I, harpethwealthpartners.com. You'll find both of our emails there, and we'd be happy to answer any questions you guys have and help you along your journey and reach financial goals. So with that being said, Brandon, anything else? We'll see you all next week.
See you guys next week.
All right.
Bye. We hope you learned something valuable today. We appreciate you including us in your journey towards financial betterment. It is important to us that you know this is for educational purposes only and not to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions about how it might be uniquely applicable to you, please discuss that with a financial professional, or, of course, we are happy to have further conversations with you about your specific questions, needs, or circumstances. We welcome you to reach out to us via our website, harpethwealthpartners.com, or by emailing Brandon at bmc@harpethwealthpartners.com. Securities are offered through LPL Financial, member FINRA SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not to be intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult appropriate qualified professionals prior to making a decision. Investing includes risk, including fluctuating prices and loss of principal. No strategy assures success or protects against loss. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. We want to thank you for your time, and we look forward to having you back next week.